Real quick around the horn, because we're going to bring Joe Terranova in on oil in a second. But before we do, I want to get a straw poll from you guys. Do you think that the oil markets are basically setting up for a long-term pricing, and that is a speculative question, of course, over the next 1, 2, 3 years, that it's going to be 120 or higher? Jeff?
Yes, I do. Yes, it's when this many smart people try to explain a trend that is so nakedly obvious as the uptrend in oil, it's going to continue much longer than.
What do you say, Guy?
I mean, it looks that way, but you can't make it. Yeah.
Karen?
Yeah, same as Guy. I know, and he said it so eloquently. I'm just going to go with that.
One reason why, Dylan, and this is another factor, is production. When you look at ExxonMobil, the biggest in the world, right? Their production levels have been coming down. The Russians have some real issues over there. Their material is really starting to fall apart right now. Their production's dropping as well. That's why the service sector is still the best.
And to that end, Joe Terranova argues Pete's point. He says it is a supply issue more than a speculation issue. Take a look.
Oil prices continue to rise. Is it speculated? Is it the falling dollar? What's the reasoning behind it? I will tell you that it is a concern about growing our oil supply. Taking a look at the futures contracts from today, the spot price 2010 all the way out to 2016. Where were they on January 1st? Where are they today? And what does it represent? You want pricing power? You get it if you're a company. You get it in the front of the board. That's up $24 year to date. But the real problem is pricing pressure. Pricing pressure is what you see going out further on the curve. Pricing pressure comes when you see the 2010 contract up $30, more than 24 in the front. How about up 29 in 2012, up 28 in 2014, and in 2016 we price oil at $116. That's up $27 on the year. If we weren't so concerned about how to grow supply, these contracts going further out along the board would be priced far less than they are in the front. This represents that we have a problem that's going to stick around for the next few years. How do we grow our supply to meet a worldwide global demand for oil?
All right, so maybe you're right, maybe you're wrong. We don't have time to debate it, but certainly the market is validating where you're headed for sure. For those who agree with the thesis that you assert, the best way to trade it is what, Joe?
Best way to trade it is somewhat what Jeff said, is just stay long oil. Keep it simple. Make it simple. If you need to make it a little bit complicated, go with the shotgun approach. You're not that smart. I'm not that smart to figure it out. Pick 5 names, shotgun it, and stay with.
But 5 names from anything from services to integrated to refinery. When you say 5 names, what category?
All the above.
Anything in the energy business.
All the above. But make sure you have the ETF involved in it.
Okay.
And if you want Hess is directly tethered to the price, the spot price of oil. One of the reasons why Hess is up 90%.
Let's say you've watched from the sidelines as this has happened,
right,
in disbelief. From an investment standpoint, would you originate a new position tomorrow at 124, 125 in the USO?
Take the chart of oil, strip the price off the side of it, look at that chart, and tell me if you want to be bullish and long that chart. I certainly would. The only thing that scares people is the price along the side of the chart.
Fair enough. Mr. Terranova, we'll see you sooner rather than later. Joe Terranova on the energy markets.